Good day, and welcome to Ujjivan Small Finance Bank Q4 FY25 earnings call, hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ranesh Boa from ICICI Securities. Thank you, and over to you, sir.
Hi. Thank you. Good evening, everyone, and welcome to Ujjivan Small Finance Bank Q4 FY25 earnings call. On behalf of ICICI Securities, I would like to thank Ujjivan SFB management team for giving us the opportunity to host this call. Today, we have with us the entire top management team of Ujjivan SFB, represented by Mr. Sanjeev Nautiyal, MD and CEO, Carol Furtado, Executive Director, Balakrishna Kamath, CFO, Ashish Goel, Chief Credit Officer, Martin PS, Chief Operating Officer, Mr. Vibhas, Head Microbanking, Mr. Yendra Jha, Retail Liability and Task Head, and Mr. Gaurav Shah, Lead Investor Relations. I will now hand over the call to Mr. Sanjeev for his opening remarks, and then we'll open the floor for Q&A. Over to you, sir.
Thank you, please. Good evening and welcome to our Q4 earnings call. Please be informed that references made during this address to Q3 and Q4 pertains to financial year 24-25. Q4 concludes an eventful year at Ujjivan. The year saw new leadership assume the positions of MD and CEO, Executive Director, Chief Financial Officer, and Head of Retail Liabilities, infusing in Ujjivan vast management experience and exposure across banking and financial industry. Bank successfully navigated the challenging business environment in the microbanking segment, maintaining one of the best in the industry portfolio quality. Strategic initiative to diversify and build higher share of secured loan book saw significant progress, now contributing 44% of the loan portfolio, up from 30% last year. While the banking system liquidity continued to see challenges, this was managed at optimal levels, with credit-to-deposit ratio improving to around 85% and LCR managed comfortably around 120%. Further, in February 25, the bank took a major step forward by filing application with RBI to transition to a universal bank. Disbursements for Q4 have been the highest ever in history of Ujjivan at rupees 7,444 crore, up 39% Q-on-Q and 11% YOY. The gross loan book reached 32,122 crore, up 5% Q-on-Q and 8% YOY. The secured book crossed 13,988 crore, up 17% QOQ and 56% YOY. Following are the major highlights. Housing vertical saw robust disbursement in Q4 of rupees 1,130 crore, up 39% Q-on-Q. The loan book reached 7,308 crore, up 14% QOQ and 48% YOY, becoming a meaningfully significant player in the affordable housing space. MSME business witnessed an impressive growth during Q4, led by revamped and newer products of LAP, working capital and supply chain. The disbursements at 533 crore, up 61% QOQ, is all-time high, resulting in loan book reaching rupees 2,047 crore, growth of 21% QOQ and 45% YOY. Current account balances from MSME customers grew 70% YOY, showing traction in our strategy to build liability through MSME assets. FIG continued its growth journey, reaching rupees 2,785 crore, up 23% QOQ. Another significant highlight was the performance of newer product lines of the bank, the disbursements for which contributed 11% to the bank's disbursements in Q4. Micro mortgages, higher yielding lower ticket size product within housing, now contributes rupees 723 crore, growing 37% QOQ and 258% YOY. Working capital and supply chain finance, the business banking segment, now contributes more than 20% to MSME book. Vehicle finance witnessed impressive growth, reaching a book size of 468 crore, up 25% QOQ and 166% YOY. Agri banking reached a loan book of 323 crores, up 66% QOQ and 276% YOY. Gold loan gained momentum with disbursements up 69% QOQ, taking the loan book to 196 crores as of March 25, up by 70% QOQ. On the microbanking segment, as previously guided, there was robust growth in disbursement in Q4, up 38% QOQ. Within microbanking, individual loan book grew 5% QOQ, reaching 5,182 crore, now constituting 28% of the overall microbanking book as of March 25. The GL book degrew by 4% for the quarter, in line with cautious approach adopted for the year, reaching rupees 13,090 crore. Disbursements grew to 2,787 crore, up 37% QOQ, primarily led by disbursement to good existing customers, which contributed 84% in Q4 sourcing. The full implementation of MFIN Guardrail 2 has been completed with effect from April 1st. The microbanking Bucket X collection efficiency in all states other than Karnataka showed consistent improvement, reaching 99.6% in March 25. The overall Bucket X collection efficiency reached 99.5% in March, despite Karnataka registering only 98.7%. The branch and customer-specific interventions were pivotal in managing the portfolio, making it one of the best in the industry under the current situation. We are confident that improvements in this segment, both from business and collections perspective, shall continue to ensue. Coming to the secured portfolio quality, housing GNPA reduced YOY to 1.1% as of March 25 from 1.5%. MSME saw drastic improvement, with GNPA reducing to 5.5% as of March 25 from 8.4% as of March 24. The 24 MOB MSME book has only 0.1% GNPA. Bank level NPA, gross NPA stood at 2.2% and net NPA at 0.5%. Bank effected an ARC transaction of rupees 365 crore in Q4, of which rupees 295 crore was from provision portfolio and rupees 70 crore from written off portfolio. In terms of RBI guidelines, the bank utilized rupees 69 crore towards ARC transaction from floating provision pool. As previously guided, credit cost for financial year 25 stood at 2.45% of average gross advances, including accelerated provision of rupees 46 crore, while it was 2.12% net of bad debt recovery. Closing PCR for March 25 is at 78%. On the liability front, the total deposit book closed at rupees 37,630 crore, up 9% QOQ and 20% YOY. In Q4, impressive growth in CASA was witnessed, up 11% QOQ, reaching 9,612 crore and now forming 25.5% of total deposits. Current account crossed an important milestone of rupees 1,000 crore for the first time, reaching rupees 1,118 crore as on March 25, with impressive growth of 35% Q-on-Q and 46% YOY. Retail TD plus CASA stood at rupees 26,676 crore, accounting for 71% of total deposits, experiencing a 21% YOY growth. Cost of fund increased marginally by 1 basis point and is at 7.6% for quarter 4. On financials and margins, the total income for FY25 at rupees 7,201 crore is up 11% YOY. For the quarter, total income stood at rupees 1,843 crores, up 5% QOQ. Other income grew by 57% QOQ, driven by processing fee, insurance income, and treasury income. Interest expenses increased by only rupees 5 crore Q-on-Q due to active liquidity management. However, OPEX increased by 11% QOQ, mainly due to direct business expense on account of higher disbursement, investments in newer lines of businesses, full year expenses impact of the branches opened in financial year 24, and technology investments have led to increase in operating cost. Credit cost for financial year 25 at rupees 748 crore includes the accelerated provision of rupees 46 crore and is within the limit estimated before. Due to change in asset mix towards secured, NIM for the financial year 25 came in at 8.8%, down 25 basis points from March 2024. cost to income ratio for the financial year 25 at 62%. With this, the full year PAT stands at rupees 726 crore with ROA of 1.6% and ROE of 12.4%. Microbanking portfolio saw improvement in asset quality in Q4. Green shoots are visible and business momentum also picked up in Q4. However, microbanking business is still to completely navigate couple of geography-specific issues and industry guardrail 2 mandates. Accordingly, to allow evolving situation to stabilize and offer us clearer perspective, we shall be giving our guidance for the year along with our Q1 financial year 26 results. Directionally, diversification of loan book would continue at fast pace, led by housing and MSME, ably supported by higher yielding micro mortgage, vehicle, agri and gold loan businesses. Deposits will grow in line with asset growth, keeping the CD ratio around 88%. Thank you very much. Now I hand over to the moderator, Mr. Avirat.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nidhesh Jain from Investec. Please go ahead.
Thanks for the opportunity. Is there an interest income reversal this quarter, and can you quantify that?
Yeah. Hi. Interest reversal for the quarter because of the slippages would be in the range of roughly 17 to 18 crore for the quarter.
And so how should we look at yields or yields next year, given that there will still be a migration from unsecured to secured in FY26? So, let's say, how the trajectory of yields we should build in FY26 versus what we have seen in Q4?
Yeah. Hi, Nidhesh. So, see, with the secured mix increasing and the shift towards the secured, the yields will directionally get moderated a bit. Having said that, we are also working on increasing the share of our higher yielding secured books of vehicle finance, which is giving us a yield of roughly 20% plus. Micro mortgages within housing vertical, which is also giving us a yield of 19% plus. And also gold loan, which is also giving us a yield of roughly 14% plus. And not only that, within the microbanking segment, we are also looking at increasing the share of individual loans, which is roughly 100 basis points plus over group loan. So all these factors put together should, be balancing out the NIM, the yields also for the next year.
But any range if you can give, should we build 100 basis point reduction over Q4 or less than 100 basis point reduction in over Q4 next year in terms of yields?
So as per part of the MD speech, so we mentioned that we'll be giving the guidance for the year with the Q1 results. So we'll like to refrain right now.
Sure. And with respect to the credit cost, since your SMA book has started to reduce in microfinance, and it is now quite similar to, or let's say marginally higher than business as usual SMA book. As your asset quality experience in secured business also doing quite well. So, do you see that FY26 we should see a business as usual credit cost, or do you still see that Q1, Q2 will be elevated credit cost? Because SMA book in microfinance has come down quite sharply, or is quite under control now.
Yes, we have seen a good reduction in our SMA book. So we should see this trend hopefully going forward and continue as we have seen in Q4. In fact, the PAR seems to have peaked in December. However, there are one or two areas which we are watching now. One is the impact of Guardrail 2.0 and a couple of geography, related things which are currently evolving. So yes, there will be a difference between H1 and H2 credit cost, H1 being slightly higher than H2. However, we can come up with a firmer number by the end of Q1.
Okay, sir. That's it from my side. Thank you.
Thank you.
Thank you, Nitesh.
Next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi. Thank you for taking my questions. Firstly, when I look at the reported yield for group loans and individual loan combined, there is actually slightly increased on Q-on-Q basis. I know there has been a change in methodology in terms of calculation, but there is an increase. But we had actually taken a price reduction from 1st January between 75 basis point and 115 basis points. So all the new disbursements which we did must have come at a much lower price, or this much lower price. So how come the yield has gone up Q-on-Q?
Yeah. Hi, Rajiv. Yes, we have modified the methodology on the day basis. The yields have actually gone up because of the way calculation happens. So we did an ARC transaction of amounting rupees 365 crores, out of which roughly 300 crores was within the provision pool, which was still on balance sheet. So, and the interest accrual does not happen, as we answered the previous question also. The interest reversal happens due to book moving into slippages. So due to this, the denominator effect, largely we are seeing the increase in yield happening.
Okay. And on the price reduction, there is no calibration, right? We have gone ahead and implemented that much as we had planned.
Yeah. Just to add, Rajiv, also, the mix of individual loan, which is a higher yielding portion
has gone
of
up.
microbanking,
Yeah.
has also gone up by 3 percentage points. So that is also helping the overall yield of the microbanking the segment. And yes, we have taken the rate increase also effective from 1st April, and we have implemented that. Yeah.
No. I mean, so from 1st January, we had taken a rate reduction of that quantum. And are you saying that from 1st of April, have we also kind of again reinstated a part of that reduction?
Yes, Rajiv, you are right.
Okay.
We have taken an increase from 1st of April for both GL and IL, which is a rollback of the small discount which we had given in the fourth quarter. So, because now it's a good business now and everything is going well, so we thought we should come back to our old pricing. So we had given a discount for Q4 only, which we have withdrawn.
Okay, yeah, sure. That clarifies. Sir, now the outlook on NIM, if you can share, because we are exiting NIM at 8.3. The average for the whole year is 8.8. And, we are fast moving our mix towards secured products. And I'm sure even in the next year, the growth in secured products will be much higher versus MFI. I appreciate the fact that, we have kind of, rolled back the pricing again in MFI, which will help us. But from a mix perspective, and as per what's your sense on how the cost of funds will move going ahead, because, the bulk pricing has actually come off. And have you taken any rate actions on the term deposits or SA rate, soft rate? If you can just kind of answer all of these points and maybe give us some conclusion about some outlook about how the NIMs will, play out.
Yes, Rajiv, we'll give you a broad sense on both the NIM side as well as the cost of fund side. NIM, yes, since the secured loan will be moving up in percentage, there will be some reduction, but not very material due to the fact that we have increased the rates again from 1st of April. That benefit will come. Plus, we have high-yielding products, as explained earlier, which is a vehicle loan. The individual loan also is doing well. So that will sustain that. And now coming to the cost of fund side, yes, we have taken a reduction both on the SA side as well as on the TD side. Bulk deposit rates also have come down. And, already 2 repo rate reductions have happened as per the RBI's, rate action. And we estimate that our cost of funds will definitely come down by at least 25 to 30 bips over next year. Considering these 2 reductions, if any more happen, then it will be subject to that. So the NIM side, yes, will be more or less there. There will be only a small reduction as compared to this year.
Got that. And just one last thing, sir. From a slightly longer term point of view, in the next 2-3 years, where are we in terms of, the profitability of the secured businesses, housing finance, MSME finance business? I mean, we've been doing this business for a while now, and there is good growth as well. When do we achieve what level of ROA? I mean, is there some broader, outlook, on these secured products in terms of profitability roadmap?
Yes, we are working on it. We have recently again relaunched the vehicle loan. Gold loan is a new product. So it will take around 18 to 24 months for it to come to a good profitability level. Yes, we should aim for 2% ROA for the new products also going forward. So we are working on that. Maybe over the next 2-3 years, once it reaches a certain level, which we are aspiring to, maybe gold loan around 1,000 crore, vehicle loan around 1,500 crore. At that time, it will start making good profits and will sustain going forward. So anything more you would like to know about that?
No, maybe I'm sure once you come out with the guidance and maybe more questioning, I'll have more questions I'll have at that time. So this is it, sir. This helps right now. Thank you so much, investor.
Yeah.
Thank you. The next question is from the line of Sagar Shah from Spark PWM. Please go ahead.
Good evening, sir, and thank you for the opportunity. My first question was regarding to our OPEX. In this quarter, our employee, we had some sort of serious off-roll collection team increase also. But our employee expenditure also increased by almost 18% YOY, and also sequentially it increased by almost by 13%. So what led to the increase, or is it some sort of a one-off in these numbers, or is it just a temporary blip? Can you explain about this? This is my first question.
Yeah, I'll take that question. Yes, you rightly noted the OPEX has gone up. That is because we have made certain investments towards improving our secured book and on the liability business. And for that, we have hired some employees. And also on the collection side, you rightly observed, we increased the manpower due to the difficult market conditions. You might have noted our PAR and our credit cost is almost half of what is there in the market, so we have invested in that. So this is directionally, it will come down as, our dispersals grow, because last year our dispersal in the unsecured side was a little muted, though the secured was doing good. But next year, both the segments should show growth, and we'll come out with more details of that when we give the guidance. And then the operating cost will, as a percentage, will get tempered going forward.
Okay. Fine, sir. My second question, sir, was regarding our GL portfolio. Our GL portfolio obviously degrew also by sequentially, but I observed there was some sort of a disbursement growth even in IL and even in micro group loans actually. So first of all, can you give some color that in which geographies are you getting confidence actually? And will in the same geographies in FY26 will we resume growth at least in this segment?
Hi, sir. So in microfinance, in both GL and IL, first of all, IL is something which we, which is our growth driver in microfinance for a long time. This is something which we have built over a period of time, and this is some product which we are doing everywhere because you get good customers everywhere. So it is a graduation product and, which is well-refined process where we are doing, customer graduation. And even in difficult market, it works because you have good customers there as well. As far as GL is concerned, GL has degrown a little bit in this financial year. But at the same time, when we look at geographies, we see that there are green shoots in various states. Apart from one or two states, and within those states, few districts are affected. But apart from that, we are seeing that eastern part of the country, northern part of the country, and even western part of the country is doing well for us. And we see growth coming from these geographies in the coming this financial year also.
Okay, so is it safe to assume, sir, or can you specify the geographies in which you are seeing green shoots? And in FY26, will we see a positive trajectory as far as group loans is concerned?
So we are looking at eastern part. That means West Bengal, Bihar, Jharkhand, even Uttar Pradesh, okay. And in north part, Punjab issue is also over. Punjab, Haryana, Rajasthan, Gujarat, and Maharashtra. These are the states where our presence is good and our portfolio is doing well. As far as south is concerned, you know that Karnataka, it will take some time to completely recover. And then we'll see some, good volume here also. But at the same time, in South, IL is something where we are looking at growth here as well.
Okay, fine, sir. So my last question was regarding to our floating provisions. We utilized around 40 crores of worth of floating provision this quarter. We even did some 30 crores of accelerated provisions. Now my question was that we still hold around 130 crores of contingency provisions also. Collectively 181, but around 130 we have easily had. So when we had such a huge credit cost in this quarter, so why didn't we use somewhat of more provisions actually in this quarter to at least to contain our credit costs actually?
Okay, so in terms of floating provision, see, we have used 69 crores against the ARC sale, which we had done during this quarter. So the number is 69. We still hold about 150 crores of floating provision, which is earmarked towards GNPA, and about 30 crores, which is earmarked towards Tier 2 capital. So of the 150 crore, we are currently using 130 crore for GNPA and NNPA calculation, and 20 crore is unutilized. So as far as utilization of floating provision is concerned, we cannot directly utilize floating provision. These are made for the purpose of contingencies, and this can be done only after specific approval from RBI. So for the ARC transaction, the RBI guidelines allow the utilization of floating provisions. So this is what we have done in Q4.
Okay, fine, sir. Now just last bit, if I can squeeze in more, that I know you're not giving guidance. I'm not repeating that to give you any guidance for NIMs or yields, but as per my self-calculation, our self-calculated yields as per the earmark yields that you have given in the presentation and the kind of disbursements that you are seeing in the secured front, the yields are coming approximately at around 18 to 19%. So is it safe to assume that at least will remain in this range, or still it's not sure based on because of the portfolio mix that you had alluded to before, that will stay at around 50-50 between secured and unsecured. So is it safe to assume that the yields will be in that range which I just said?
No, as already mentioned, we would like to give the guidance along with the Q1 results. So at this stage, we would not be able to elaborate any further on this subject. We'll give you the correct estimate along with the Q1 results.
Okay. Fine, sir. All the best and thank you.
Thank you, Sagar.
Thank you so much. Yeah. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Thank you for giving me the opportunity. So my question was on collection trends in April, as we've already sort of concluded the month. So how has it been for microfinance? given that, the MFIN 2.0 guardrails would have also got implemented with respect to lender cap?
So, as you mentioned that, apart from, few states, especially in South, we are seeing positive momentum in both in business and collection across the country. And our last quarter has been very, very good in terms of collections. And we are continuing that momentum in the month of April also. And we hope that this quarter will also be similar to or better than the last quarter.
Got it. The second question was on the loan book mix front. So we've launched newer products such as gold, among others. How are we seeing that share inching up in the next, let's say, a 12 months time period? Because these products are also not only secure but also decently positioned when it comes to ROA profile. So what is our thought process in terms of their contribution by FY26 end or by FY27 end? If you could give some color there.
So gold loan is a new product for us. We started with almost a very small book, and we've scaled it up to about 200 crores during this year. This has got enabled by rollout of this business in 4 quarters. So every quarter we started opening branches, and we now are currently present in about 200 branches. We will continue to open branches for gold loan during this quarter, largely in H1 and then some branches in H2 also. So, continuously opening branches, continuously putting people for gold loan acquisition. This is the plan that we have in mind. By end of next year, FY26, we expect that this book will be about 2.5 to 3% of the overall AUM.
So this is only gold and vehicle, which is another, I think 480 crore that we have built. So I'm saying that new products as a category, how would that be contributing in let's say FY26 and or 27? Because today, as we see that book is almost, I would say, 1,000 crore portfolio. So yeah.
So these are very important new products that we have done in the last 18 months. Vehicle loan, for example, we now are touching 500 crore, but we've built a capacity to be able to disburse in the range of 70 to 80 crores during season times. So we've tested ourselves last season, and by season I mean September, October, November, and December, when the two-wheeler sales are actually August, September, October, November, when two-wheeler sales are at their peak during the year. We have tested ourselves. We've touched 75 crores in a month. So this year also we will go with the same momentum. This, of course, is a dealer-based business, not a branch-based one, unlike gold loans. So we have done, tie-ups across dealerships. This year also the distribution footprint will increase again. So the growth in vehicle loans, two-wheeler, will continue with the same pace this year also.
Got it. And just one data keeping question. What is the write-off for this quarter and full year?
Sorry to interrupt.
Just one second. We are checking the number.
Yeah, that's my last question. Okay.
₹362 crore for the full year. Yeah. So it was 362 for the full year.
All right. Yeah. Thank you so much. Thank you. Good luck for the next one.
Thank you. The next question is from the line of Shailesh Kanani from Centrium Broking. Please go ahead.
Good evening, and thanks for the opportunity. A couple of questions from my side. One on the MFI segment, as you have alluded to in the opening remarks as well, there has been a good jump in disbursement, and overall also in our numbers also it is getting reflected. So is it safe to assume, or is it safe to understand that the worst in terms of credit cost and MFI cycle is over, and FY26 again we would be seeing some growth, not maybe very high, but some growth for both JLG and IL. I know it's doing well, but even on the JLG front, can you throw some light on that?
Yeah. So, we, in Q4, the increase in disbursements has come largely on the back of repeat customers. So we saw demand coming back in the market. You must have noticed that in Q2 as well as Q3, the disbursements for the industry was low. Q2 YOY disbursement was low by about 28% below normal, and in Q3 it was down by about 35% below normal. So repeat customer demand had to come back, and that is what we saw happening during the quarter. Now, in terms of, I'm sorry, what was the second question?
In terms of if the worst was
for the full year, for the full year, yes. See, there has been muted disbursement for almost 9 months in the industry. So there is demand coming back. We will also see some new customer acquisition during the year. That has been something that we have not done over the last 9 months. And we will also see as collection efficiency improves, branches will start to acquire more customers. Because, in the last maybe couple of quarters, branches have been spending a lot more time in collecting from overdue customers. And that has slowed down our new customer acquisition speed also. Plus, we were a little more cautious. We were only servicing repeat customers all this time. So on both sides, yes, in terms of customers getting added, we will see some addition this year. And in terms of branches doing higher disbursements, we have already started seeing the trend, and we'll see that this trend will continue.
Sorry to harp on this, but just to understand what we are doing different than, say, other players, because our disbursement, if I see on year-on-year basis, GL and IL combined, it's nearly flattish, not a huge dip, right? Whereas many of the players have kind of, even on year-on-year basis, depicted a huge decline. So any quantitative factor which you would like to throw out means why this performance is a little bit better than the peers?
There are 2-3 reasons to this. One of which is we have very good geographic diversification. And because of the geography diversification, we've not got impacted in a big way in any of the states whenever lower concentration has been one of the reasons. The second, of course, is IL now contributing to 28% of the book. The impact of Guardrail 1 was largely on GL. So IL had a lesser impact compared to GL. So that also helped us in maintaining asset quality. The third one is, as soon as we had started to see stress, we had divided our branches into green, amber, and red based on their collection efficiency. And, the disbursements, the pace at which they would grow or degrow was largely dependent on the categorization of these branches. So, in green branches, we were doing business as normal because collections were normal. And in red branches, restrictions were put throughout the last 2 or 3 quarters. That also helped us in, not taking additional risks in places which were not doing well, and continuing with disbursements as normal in green branches. So this was one of the reasons why the disbursement trend did not show a very steep decline.
Okay, sir. So just last question, one question on the FIG front. I'm seeing a jump in the disbursement in FIG as well. Considering I believe the yields would be one of the lowest, why we are having a growth over there? Any views on that?
So FIG has always been a strategic book for us, and we have been, looking into disbursements a little differently. We have a good hold on the FIG book. So at the moment, yes, we see that the FIG book has grown, and we will ensure that this book is not more than 8 to 10% of our total portfolio. And we generally lend to NBFCs which are engaged in MSME, vehicle finance, gold, and also our focus area continues to be on the higher rated entities, A plus and above. And we also have a spread of around 1.25 to 2.75% for these loans. It is based on the credit profile of the borrowers. And, finally, this book has largely been having around A and A-rated entities. We have some good names also in this book. And we did a total disbursement of around 1,064 crores in Q3. So this book has always been a strategic book for us.
Okay, that's helpful. Thanks a lot and best of luck.
Thank you. The next question is from the line of Aravind R. from Sundaram Alternates. Please go ahead.
Hello, sir. Thank you so much for the opportunity. Just a clarification question. So the interest rate reduction which we offered during the fourth quarter in individual and group lending, is it only a temporary thing? And now the interest rates are again reversed back to the normal rates?
Yes, you are right. We had given some discount for the fourth quarter because we wanted to improve the business. And now it is more or less restored back to the normal. The discount has been withdrawn.
Okay.
I think so that one thing is that even after increase in interest rate, we are one of the best interest offering, organization in terms of microfinance loan in the market.
Yeah, definitely, sir. Also, do we see any repricing in any other part of the portfolio, either in terms of increase or reduction?
No, as of now, we don't envisage any change in our pricing. We'll have to wait and see how it goes, but as of now, we don't have any such plan. Yes.
Sure. Thank you.
Thank you. The next question is from the line of Ashlesh Sonje from Kotak Securities. Please go ahead.
Hi team, good evening. First question is a data keeping one. Can you just break out the slippages by segment? I just need the MFI slippage number, if you can share that.
1 second, we'll pull it up.
So in the meanwhile, if I can take the second one. The second one is on slide number 24 in the presentation, where you have shared the PAR trend for leveraged customers, Ujjivan plus 1, 2, and 3, and so on. Over there, if you see the Ujjivan plus 4 PAR number, that has climbed up to 30% as on February, whereas the Ujjivan plus 3 number is about 13%. Now that the 3-lender cap has been implemented, do you think the 13% number, which is for Ujjivan plus 3, that can climb up to a 30% kind of level?
Ashlesh, in terms of breakup of slippages, we had about 87% of the slippages coming in from microbanking for the quarter. As you know, for the 87% of the bank slippages came in from microbanking. In terms of Ujjivan plus 3, Ujjivan plus 4, we've seen a decline happening in Ujjivan plus 3 in the last quarter. January we seem to have seen a higher number. It was climbing up. In Feb it came down, and in March it has come down further. So we feel that this trend should continue. Because of Guardrail 2 implementation, there might be a month or two where we can find some disturbance, but overall we don't see this number going up to 30%. It should be much lower than that.
Understood. Thank you. And sir, just lastly, what is the total pool of return of loans where you expect to make some recoveries?
So, see, this is divided into two parts, Ashlesh. One is the old ones which we had done immediately after COVID, and the second is the ones which we have done in the last 2 years. The sum of what we have done in the last 2 years is approximately 750 crores.
Understood, sir. Thank you.
Thank you. The next question is from the line of Sonal Minhas from Persicant Cap Investment Advisors LLP. Please go ahead.
Hi, sir. This is Sonal Minhas. Am I audible?
Yes, Sonal.
Hi. So my first question is with regard to the provisions, basically. I'm on slide number 23. I just wanted to understand subjectively, the provisions are actually come down. The provision coverage is basically reserves have come down from 804 to 710. And there has been a credit cost, which is reasonable in this quarter. So wanted to understand that, are you happy, are you satisfied with whatever provisions we have as we speak right now? And this is directly going into what we should see the provisions for FY 26, because the number is reduced meaningfully. So in FY Q1, Q2, FY 26, do we expect more provisioning, disproportionate amount of provisioning? If you could just help directionally explain this.
So, Sonal, we, maintain our PCR above 70%. The PCR has come down from 80% to about 78% between Q3 and Q4. In addition to this, we also have 21 crores of unutilized floating provision, which can add a further buffer if we utilize it. We've also done, accelerated provision in March, in addition to what we had done in December. This quarter, we have done about 42 crores. So, in terms of PCR, I think we are fairly covered.
So even after considering the last 1 year has been kind of... Yeah, I understand, sir. My question was that our PCR is roughly, the absolute amount is roughly similar to where it was when this whole microfinance kind of stress started happening. And hence, we were at, in March 24, we were at 690 crores, and right now we are at 710 CR. So directionally, should we see this number go up significantly next year? Is broadly, I wanted to understand, given this has been a year of stress, and we are roughly at the same point where we were in March 24.
So, in terms of absolute provisions, the provisions will follow the provisioning norms. As and when slippages happen, provisions will keep going up, as well as, and whenever interventions happen, the provisions will keep coming down. One of the interventions that we did in Q4 was the ARC transaction. But, for us as a mandate, we will continue to maintain PCR above 70%.
Got it. Okay. So, my second question, which we wanted to ask, the maturity of your MSME book and your affordable housing book, while the GNPA and the PAR numbers have come down YOY, any color there, any subjective guidance there you can give, in terms of how that book is behaving, that will be helpful. Yeah.
So in MSME, we relaunched the product in April 23. And post that, we have, built a book of almost 1,200 crores. In this 1,200 crores on the 24 MOB book, we've not seen NPAs. We've seen a very little PAR. NPAs are in the range of 0.1%. So the book is holding well for us. And, this has three components. One is LAP, the second is working capital, which is overdraft products, and the third one is supply chain finance. So in all the three products, we've seen the 24 MOB book hold. In terms of reduction in NPA, the old book has contributed to the NPA, and that is what we're seeing recoveries happening from there. And in the last year itself, we saw more than 35 to 37 crores of recoveries happening from the old book. We are currently, we've done SARFAESI in all the NPA accounts. Almost 33% of those are in advanced stages. so either waiting for auction or waiting for enforcement of security. So we see that, this trend of reduction of NPAs should continue in the old book. And old book is now reducing at a very fast pace. So the residual book is likely to have a higher NPA, but the slippages have now come under control, with the new book now contributing to the overall MSME book.
Okay. So the newer book, as you said, is behaving well. So is there a time in future, maybe next 12 months, 18 months, where the old book has been reduced significantly in margins, and this book basically starts, there is a maturity curve basically beyond which it comes back to industry average? Or what would you see in MSME, which is typically 3 to 5% kind of NPAs basically?
No, so when we look at MSME book, it is the NPAs are largely guided by the segments in which we operate. Our old book was of a 15 lakh rupee ticket size, and the moment COVID happened, it was this ticket size was the one which got impacted the most, the lower end of the segment. In the book that we have relaunched, we now operate with an average ticket size of about 55 to 60 lakhs on the LAP side. And on the working capital, which is overdraft, the average ticket size is close to about 1 crore. So it's a complete new segment that we are working with. So therefore, we feel that the asset quality, being dependent on the segment in which we are operating, should be much better than what we see across the industry.
The previous. Okay. And what is an average?
The previous one was
that ticket size? In that ticket size, what is an industry?
No, again, depending on the segment, we are operating in the 50 lakh plus segment on LAP, and 75 to 1 crore in working capital, maybe about 1.5 crores. So these segments are relatively unaffected by any small downturns that we see. So we should see this, this segment normally behaves very well in the industry.
Okay, so industry average numbers, they are also pretty low, less than 2%, less than 3%. I think that is the number. I just want to answer.
Yes. Yes, the industry numbers are also very low in this. The delinquencies are low in these segments.
Got it. Okay. That's it from my side. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir, and congratulations on a good set of performance. Sir, most of the questions have been answered.
Sorry, we are not able to hear clearly. We are not able to hear clearly.
Could you speak a bit better? Are you able to hear now?
Yes.
Hello?
Yes, you are.
Hello?
Yes.
Yes, Sarvesh.
My question was pertaining to Karnataka and Tamil Nadu, where these ordinances have been introduced or are in the place. So, how are you seeing the situation, sir? Is it like, so we have seen a dip in asset quality in all the other states, and that dip sort of bottomed out in the month of November, and then steadily things have been improving, as you said, in 3 of the 4 regions of the country. So in these particular states, after, for example, in Karnataka, we saw a dip in Jan and then Feb. And now, is it just improving just like every other region, but with a lag of 1 or 2 months? Or are we seeing some other issues which we think will persist over some time? And same for Tamil Nadu, sir.
Sorry, Sarvesh, is this only for Karnataka? Yes, Karnataka, we saw a dip in collection efficiency in February, and it did not come back to normal in the month of March. In March also we had 98.7. What we consider normal is in the range of 99.5 bucket X collection efficiency. So there have been about 7 or 8 districts in Karnataka which have still not come back to normalcy. These may probably take another 2 to 3 months before they come back to normalcy. In most of the other districts in Karnataka, we have started to see improvement. So the bucket X collection efficiency, which had actually gone down to below 97, recovered to 98.6 only because most of the other districts started to respond well, but about 5 or 6 districts still did not respond in the month of March.
And what is happening on the ground? Is it like the borrowers are refusing to pay, or are you not able to send your collectors to collect the money, or there is some confusion between registered and unregistered entities? If you can throw some color on the ground situation in these districts that are facing challenges.
So, the risk around people going and meeting customers, that was a little elevated in the month of February. But we saw a significant reduction in that in the month of March. People were, going and meeting customers. There was no resistance in going and meeting. However, as I was saying, in about 7 districts, there was lower repayment rates because people wanted some time to pay. Most of the narrative that we've been hearing is we will pay, but not now. There has been deferment of promises to pay, especially in the month of March.
Okay. And now in Tamil Nadu, if you
But on ground, things are normal. On ground, things are normal now.
No, I was referring to Tamil Nadu. So Tamil Nadu, sir, what is happening and what you have seen in the month of April, if you can throw some light on that.
So Tamil Nadu is just about a week old. It has not even reached people as of now because the developments are not more than a week old. There was in Karnataka, it had taken about 2 or 3 months of attention by people, and it had various colors happening in various districts. In Tamil Nadu, I think this has this been only a week, and the bill has already gone. It has already got passed. So this is in Tamil Nadu. We should see a much lesser disruption if there is any, because of no disturbance on the field. In Karnataka it was escalating. Here it has been a very smooth situation.
Okay. Understood. And sir, the other question is on the OPEX piece. So, so our OPEX was even trending higher before in the earlier quarters of this financial year. Then I think we saw some moderation, and then again it has spiked up. So, how do you see that trending out? Is it because we are running on a very low utilization for the secured business, which is causing this OPEX to be on the higher side, or there are some one-offs related to the collection, because this, even in the past post-COVID crisis, we had ramped up our collection team, and that had resulted in some OPEX spike. So how much of this sort of an OPEX trend can be explained because of...
Sorry to interrupt, Mr. Sarvesh. May we request that you return to the question queue for follow-up questions, as there are several participants waiting for their turn.
Yeah, okay.
Yeah, thank you. The next question is from the line of Chinmay Nema from Persecution Capital. Please go ahead.
Good evening, sir. Sir, I just had one question. Could you share how much, out of the total provisions, how much are earmarked towards the microfinance book?
Out of the floating provisions?
Sir, out of the total provisions, just trying to understand the split of the provisions between our other retail assets and the microfinance book.
We'll come back to you. We'll come back to you on that.
Okay, sure. Yeah, that's it from my side. Just one question.
Sure, Chandra. We'll come back to you on this one.
Should I take up the next question, sir?
Yes,
Hello.
please.
Yes, sir. I'll right away.
Yes, sure.
The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, just two things. Firstly, if you can just tell us what is the overall Tamil Nadu exposure at the bank level in terms of loan assets? And the second is, while from a growth point of view, we are highlighting that individual loans in microfinance are not covered by the MFI and guardrail, and hence you can grow them faster. But from a risk point of view, do we already have tight underwriting guardrails in individual loans, which will keep the PAR always below the group loans? And if you can elaborate on those guardrails that have been in place.
Sure, Rajiv. So, Tamil Nadu contributes to about 14% of the overall assets for the bank, the total loans and advances for the bank. That includes microfinance and all the other retail assets. And in terms of individual loans, this business for us has been almost 16, 17 years old. We've been, continuously improving our processes, continuously improving our underwriting standards. Most of this book, about 90% of the book in individual loans has been graduated from group loans. We have a team of about 550 credit officers who independently assess every loan application on the ground when we have to sanction a loan. So there is a dual assessment of every customer, and underwriting norms are again based on the industry, on the occupation of the customer. So this has worked well for us, and the graduation of all the group loan customers happens typically after not before 36 months. So the bank already has experience of good credit behavior of customers before we graduate them to individual loans. Yeah, Rajiv?
Yeah. No, that's good. Yeah. That's it from my side.
Thank you.
Thank you. The last question for the day is from the line of Heath Khemawat from IIFL Securities. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. Just a couple of questions. One is that we've seen some reclassification from the agri book to some individual loans and other loans. Can I know the reason for that? That is first. And secondly, with the MFIN 2.0 now coming in, which you've implemented from April, while we've seen some of your peers do it even before that, like maybe in the month of February or maybe even November 24 for some cases. So do you think that the growth might get impacted in some way when the +3, +4 borrowers come for the second loan or a repeat loan? So just those two questions, if you can get perspective on.
Yeah, hi. So we have just on the first question, we have just reclassified the loan so that it reflects the the grouping. So earlier our agri and allied loans given for individual individual loan purpose was clubbed under agri and allied. Now we have included it into individual loan, and the agri banking now reflects only about the agri banking secured portfolio.
As far as effect of Guardrail 2.0 is concerned, first of all, we believe that the impact of Guardrail 2.0 will be much lower than Guardrail 1.0 because they overlap with each other in terms of the different benchmark that we have to set or different the way we have to reject our customers. Second point is that if you look at our overlap, the 3 lender and 4 lender, we are one of the lowest. And the loss there in terms of customer not being eligible for repeat loan will be much lower than the average industry. Among those customers also, we have good customers. We have good graduation program. Not only IL, we have MLAP, we have other products also where we have very smooth graduation program, and customers can move to other products if they are eligible and their income supports. As far as this also opens up opportunity. As far as we go into the month of April and this quarter going forward after implementation of Guardrail 2.0 across the industry, customer will, I mentioned this in the last quarter also, that customer will also now choose the 3 best lender where they can continue with, and that gives an opportunity. If you have a basket of product to offer to your customers, your interest rate, your processes are faster, there are high chances that you can attract best customers in the market. So yes, there will be some will lose some customers who are eligible, who will not be eligible as they already have loan from 4 and our loan is maturing first. But at the same time, we'll also have opportunity to attract good customers, best customers in the market as well. This is also from the point of view that with the kind of stress the industry has gone through, there will be some market that will open up with some of the players not being able to disburse because of liquidity issue, and that is something we are looking at.
Got it, sir. That's helpful. And just lastly, if I may ask, on the universal banking license, any update on that, right?
As you may be aware, we have filed for the universal banking license in February, and we await to hear from the RBI on this matter.
Okay, that's helpful, sir. Thank you.
Thank you. This was the last question for the day. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.